Welcome back, traders and investors. We have Guy Spier on the line. He's managing partner at Aquamarine Capital and the author of The Education of a Value Investor. Guy, how you doing this morning?
I'm doing great, Joel. Sitting in the very middle of the country in Chicago. It's been a great tour, actually. I've been meeting a lot of fantastic people who've connected with the message of the book, so I'm quite pleased and quite happy.
Where are you from?
I am originally, I grew up primarily in the UK, which is the accent that you hear.
Okay.
But I spent 18 years in the United States. I came here to do an MBA and then continued after my MBA in Boston to work on Wall Street for a couple of years before finding out about Warren Buffett, reading The Intelligent Investor, and getting religion.
All in the same stroke, huh? Okay. So you're living now overseas?
What happened to me is that I got very caught up with the maelstrom of Wall Street, and I was very taken with Warren Buffett's approach to calmly and quietly looking at stocks and understanding their value. I found it very difficult to do in New York. And over time, I realized that there were a number of people who had lived in New York but then moved back to somewhere else. So Warren Buffett had been in New York for a while and went back to Omaha, Nebraska. So John Templeton moved to the Bahamas. And so 5 years ago, just about 6 months after I had lunch with Warren Buffett, I and my wife took the decision to move to Zurich, Switzerland, and sort of create my own Omaha out there.
Oh, wow, that's a good place to do it. So you're out promoting your book here, The Education of a Value Investor?
That's right. And I would just tell you that what is amazing today is that I think that in the past, not only did you have to be in Manhattan, you had to be right down there where the New York Stock Exchange was if you were going to get close to the information that was important. And what's happened is that you can now be anywhere because the kind of information that was only available right on Wall Street then is now available across the planet. And so I'm in Zurich, but I read a whole bunch of U.S. publications. I download 10Ks and Qs and read them in my office. So it's really an extraordinary world that we live in. And I would say that what's incredible is here we are talking, and there are people who are tuning in from all sorts of places, all sorts of geographies. And I think it's really important to realize that we often feel like, as individual investors or people who don't do it professionally, feel like they may be at a disadvantage to the professional investors. I don't think that's ever been more false than today.
With the ease of information flow, no doubt, I know exactly what you're talking about. So you started your fund with $15 million in assets, and what are you up to in assets now?
So now it's just shy of $200 million. As of the last time I checked, but I check infrequently, so I haven't checked the prices for at least 10 days or so, I would say. So I'm aware of what's going on with the companies and the portfolio, but it fluctuates, as you know.
So how did you get to have lunch with Warren Buffett?
Yeah, well, what I would tell you, the surprising thing is that it was all about thank you notes, and a bidding partner and I, Monish Pabrai, bid on and won the lunch. But I would have never bid on the lunch if I had never met Monish Pabrai. And the only reason why I met him was that I wrote a thank you note after one of his partnership meetings, and he reached out. And it was one of thousands of thank you notes that I've written in my life. But it's amazing because most of them don't get responded to, or the person just puts them away. But you can have just one out of 1,000 that somebody responds to. And in this case, Monish Pabrai responded, and a friendship developed out of it. And he convinced me, he brought up the idea of having lunch with Warren Buffett, and I thought it was a dumb idea. I thought that's a pretty expensive lunch. And he explained how, I might end up giving money to charity but would not get lunch with anyone out of it. I just got some stupid plaque or some kind of recognition in a publication. And this was an opportunity to give to a charity and, in addition, to hang out with somebody who's an extraordinary person. So it was an example for me of how unconventional is often better. And the thing that most of us tend to do, myself included, is we hear an unconventional thought And I think that can't be right. And then it took Monish a few, sort of 20, 30 minutes to explain why it could be a very good idea. So it was a combination of, winning the auction was the smallest part of it. Meeting this friend and having him be willing to take the time to explain it to me was actually much more important.
So let's talk about that. I mean, because obviously, your style replicates the approach of the most successful investor in the world. And without going to great detail, I mean, can you come up with like 2 or 3 things that he told you that really stuck out in your mind and got you, on the path to success that you're on?
Yeah, well, I would tell you that just before we get into that, and I'm really happy to share those things, that idea of replication is so fascinating because many of us who are highly educated have this idea of don't plagiarize, have original ideas, don't copy other people, which is absolutely right in the academic world. But when you get into the world of business, it's a dumb idea. If I see somebody who's successful and doing things right, I should replicate what Monish Pabrai says, clone, clone, clone. And so the interesting thing is that when we try to replicate, I've replicated Monish Pabrai, I've replicated Warren Buffett, it becomes your own through replication. So replication is an absolutely phenomenal idea, and that probably leads into the best. One of the best lessons that we got from the launch, which was Warren Buffett said many times, hang out with people better than you, and you just can't help but improve. And there's something about just, reading about your heroes, getting to spend time with them, going to a meeting. I go every year to the Berkshire Hathaway meeting. I hang out with Warren Buffett and 40,000 other people in a room. But even that has sort of an influence on your life over time, and it helps you to make distinctions helped me to make distinctions that I might not have otherwise made. So that was, the other thing that really was so surprising to me is that you would imagine that with Berkshire Hathaway being one of the most successful and admired companies in the United States, if not on the planet, that Warren Buffett had gone about it by saying he wanted to build that. But actually there's something that came before that came through in the launch, which was that he wasn't going to change the day-to-day circumstances of his life if it was going to and make himself one little smidgen less happy for the sake of making Berkshire Hathaway more successful. So I realized in that moment that the most important thing to Warren Buffett was not the biggest, best, fastest growing Berkshire Hathaway. It was to do the best for himself in his own life, and that was a result. So it was this idea of marching to the beat of your own drummer, listening to the inner voice, and making sure that what you do is consistent with who you are. And so I realized in that moment, first of all, that Warren Buffett is very, very congruent and consistent with who he is. What you see on the outside is what there is on the inside. But what I realized was that I was not. So there I was, actually in New York City, trying to be a big honcho hedge fund guy, which actually wasn't what I was on the inside. And so it gave me the ability to make that distinction and then take action to change it.
Very interesting. So, value investors. So, where is the value in the market, or is the market overvalued at this level?
Well, there was a lot more value in 2009, in March 2009, than there is right now. That is absolutely certain. And I think that it's very hard to find value right now. I don't think that there are many things that are cheap. I think that where I'm coming from is that the vast majority of my portfolio is in equities, and a number of equities that are less undervalued now than they were 5 years ago. But I don't know where else to put my money, because with the Fed taking a very aggressive stance on interest rates, you can't earn much return if you buy fixed income instruments. And I would go even further and say that cash, we think of cash as just cash. Well, I estimate that cash is depreciating at around 5% per year, because we have some level of inflation, and I think that the inflation indicators probably understate inflation. So cash is not necessarily a safe place to hang out, neither is fixed income.
Okay. At the beginning of the year, Mr. Buffett said he kind of thought that stocks were overvalued, and we've had a pretty substantial run since the beginning of the year. I mean, you besides cash and selling, there's nothing wrong to be out of some stocks and in the cash. I mean, I know you're talking about the rate of inflation eating away your investment, but sometimes is it just better to take your chips off the table? I mean, you're better off being in cash than if the market goes down 10 or 15%.
That's absolutely right. If I could predict when that was going to happen, but my opinion is that I don't know if that might happen in the next 3 months. If I knew that for certain, then of course we'd do it. But it might take 2 or 3 years. And what might happen is that inflation might accelerate, and we might get so even though valuations come down, you won't see it in the prices in the prices of stocks, because they'll be reflecting increased inflation. And you see this in highly inflationary countries. You look at the stock market and it just seems to go up and up, and it's not going up by as much as that. It's just that there's inflation taking place. And so the good thing about staying in stocks is that it's a place to protect yourself from inflation. Whereas, again, cash is not a place to protect yourself from inflation. So, but I would tell you that what I do is I don't want to use up too many brain cycles thinking about where the market will be in the next 3 to 6 months, or even in the next 18 months. So I kind of am consciously and deliberately not trying to time the market. I can understand, though, that somebody who is more concerned about those kind of shorter-term movements would want to take some cash, some money off the table.
Do you take any kind of downside protection? Do you sell calls in any of the stocks you own? Do you have a war chest of puts, hiding out, or are you ready? Do you have an S&P futures account that you're ready to short the futures if in fact something comes up, or are you just in the faith, they have the blind faith in the market just continue to move higher?
I mean, I wouldn't. I'd like to describe it not as blind faith. I would just like to describe it as a choice between. I would argue that those things are all sort of insurance against a short-term downturn, and I could buy that insurance. The problem is that I don't want to pay up for it, and I believe that over a long period of time, and I'm talking about an investing lifetime of 20 to 30 years, if I make the choice. Which choice do I want? I would prefer not to buy the insurance and have returns that are higher by 50 to 100 or 200 basis points than to buy the insurance. So it's a decision, a state of the world that I want to live in that is based on sort of very long-term thinking. And it's not dissimilar to the idea that, the Walton family did not think about short-term moves. They just were in Walmart for a very, very long time. And the same with the Kroc family with McDonald's, and the same with those of us who own our home. And so it's that kind of thinking that tells me that I don't want to do the kinds of very rational insurance policies that you're talking about.
What would change your mind? I mean, you've had a very accommodative Fed for the last several years. There was a lot of trepidation last week about what the wording would be considerable time. Is there anything that, the Fed or, I mean, there's also, geopolitical factors which we cannot predict. Is there anything that would change your stance?
Yeah, I mean, I think that if we saw the United States make very real moves towards balancing the budget, for example, and I could see very clearly that the budget deficit, the U.S. government budget deficit, was coming into line and was coming under control. So I had a very clear indication about the soundness of money, and that holding cash was something that the Federal Reserve took seriously as a store of value. Then that would be a reason to take money off the table. But I don't see that happening. In fact, I see the opposite happening. And when you see, when you see the U.S. government trashing its own currency, then why would I want to hold that paper? There are so many businesses that are productive that issue paper. I'd rather hold their paper.
Okay, and could you give us an example of some of those countries?
that don't trash their paper. I mean,
Yes, correct.
the country where I live, Switzerland, is a couple of years ago they had a budget surplus, so they took in more money from their taxpayers than they actually spent. That's extremely unusual. So there are countries that do it, but what we have, unfortunately, in the United States and many other liberal democracies is, this idea that you can vote yourself more money. And so we elect people into government who think that it's all about just voting yourself more money, and of course that doesn't work. And then it turns out that the least painful way to deal with that is to inflate the currency, which is what we have going on in Western Europe and in North America. And you don't want to. It's not fair to talk about the people doing that as evil. They're not being evil. They're taking the best option that they can take given the circumstances.
Okay, any final words of advice for long-term investors in the market?
Yes, I would say that the thing that I've learned time and again is that when I've had trouble in my investing or in my life, is to seek answers inside myself rather than outside. And the most important thing with investing and trading is to make sure that what we do is consistent with who we are on the inside. So I can see somebody else who does a move, and that may be the right move for them, but it may not be the right move for me. And that's all about understanding who we are, understanding our own particular approach to money, our own particular connection and emotional connection to money, and to know that feeling of knowing that it's right for me is much more important than whatever the market is telling me.
Okay, Guy Spier, managing partner at Aquamarine Capital and the author of The Education of a Value Investor, giving us his very straightforward approach to the market. We appreciate you coming on, Guy, and hope to speak to you again soon. And I hope I get one of those thank you notes.
I'll be working on it. I've spoken to quite a few people, but it's been a pleasure to speak to you, Joel. I hope to talk to you again.
Okay, thank you.
Thank you.